You also have a new note out actually talking about 10 topics. What will be at the forefront of what markets will look at? Is it an inverted yield curve? Is it FOMC minutes, or is it the trade concerns with China?
Well, it's difficult to pick any one of those. They're all important. Fair. And I think they all also relate to the concerns that investors have had, particularly at the end of last year, about an impending recession. And part of that fear about recession reflected the yield curve flattening. Part of it was relating to trade issues. Those concerns have moderated with the rally that we've seen in January, rightly in our view, because we think a recession is unlikely. But I think people are going to be very, very focused on the hard data as opposed to the survey data, which really sort of led this panic at the end of last year.
So, Peter, what are you expecting markets broadly in the U.S. to do? Is it kind of range-bound, a little bit like what we're seeing in the cable?
Yes.
And this is what, just because there's a slowdown and there's no real impetus for upside growth?
Yeah, I think that what we saw at the end of last year was too much negativity being priced in by investors, predominantly about the fears of a recession, which we think are unlikely. In the context of that, finally, we saw valuations coming down really quite a lot across all equity markets. And we've now seen a rebound back to levels which are consistent with slow but moderate growth. I think the upside for equity markets is capped somewhat because we don't see valuations really driving higher. And at the same time, profits growth, which is likely to be positive, is also likely to be pretty moderate. So we're looking at around 6% growth in the US this year, around 4% in Europe and 3% across Asia. Positive but moderate, and that's what really should drive the return.